You're listening to What's Up Digital Lending, the podcast that explores the exciting world of digital lending. We make a deep dive into the most important issues and talk to the leading minds of the ecosystem.
Hi everybody, my guests today in this episode number 19 are Claus Tumbrägel, co-founder and co-CEO at nordIX. This is an asset manager with a focus on digital consumer loans located in Germany. Roman Feranek, founder and CEO at ZLTY Melon. This is a fintech lender located in Slovakia. Last but not least, Darius Noreika, CEO at FinB from Lithuania, another lender in today's show. My name is Konstantin Fabricius and I'm the host of this podcast. Today, I would like to elaborate with my guests on the current market developments in consumer lending. And there is so much to talk about. What are, for example, the current risks and opportunities? What are the returns and defaults? What can they tell about the distribution of market shares between bank lenders and non-bank digital lenders in view of the 700 billion market in Europe? How do they deal with the aspect of financial consumer protection and over-indebtedness, respectively, on the one side, and the interest of the investors to receive their monies back, ideally plus interest, on the other side? Many of these investors are retail investors. This question has become increasingly important, not least in the context of the revised Consumer Credit Directive and the increased requirements on credit risk assessment. I would also like to touch base on future regulation. Currently, the European Commission is exploring the option to integrate the consumer credit into the European Crowdfunding Service Provider Regulation, according to Article 46, Section 2 of the Consumer Credit Directive. From my point of view, this is a marvelous chance to hinge the digital consumer loan on the wide capital market and regulate it uniformly. There are voices in the market, however, who argue the Fund Manager Directive would be the better choice. Let's see what our three experts think about all of this. Before we start, however, listen carefully to the following, please. The content of this podcast is expressly not to be considered investment advice, but is intended solely for your information. We do not assume any liability and will not share any profits. Okay. Claus, Roman, Darius, welcome to our show.
Hello.
Hi there.
Hi, Konstantin.
Yeah, guys, please tell us a little bit about yourselves. Who are you and which company do you represent today? Please also describe your company in 2-3 sentences for the audience. Who would like to start?
Do you want me to kick off? So you mentioned my name first, and I'm
Please, go ahead,
first in the alphabet was Claus. Yeah, my name is Claus Tumbrägel. I'm probably the oldest one here. I'm 57 years old. I founded after my banking career in 2009. I founded a company called nordIX. We are a fixed income asset management boutique based in Hamburg, managing roughly a bit more than €500 million in different strategies. Our youngest strategy, which we introduced in April 21, is a fund which is called the European Consumer Credit Fund, where we purchase consumer loans originated by non-banking lenders across Europe. We are currently investing in 13 countries. Today, we've signed a contract with a German lending company. We're investing in 13 countries with 15 different lenders. The fund is growing nicely, and I'm happy to tell more about it during this podcast.
Thank you, Claus. Who would like to go next? Darius?
Yeah, so I can go next, based on alphabet. So hi, my name is Darius Noreika. I'm one of the co-founders and the CEO of FinB. FinB is an alternative lender for consumers and SMEs. Originally, FinB started business in Lithuania. In the end of last year, we started the lending operations, SME lending operations in Polish market. So now we are operating in Lithuania and Poland. We are in the market for 10 years now. So it's our anniversary this year. FinB started as a purely peer-to-peer lending platform in the early days, but currently we utilize more diversified funding sources. We still have peer-to-peer lending. We also issue bonds, mostly in local market, Lithuania market, And we also cooperate with institutional investors such as nordIX, and we have some other partners as well.
Okay, great. Thank you, Darius. Roman.
Hello again. So my name is Roman Ferenc. I represent company iService, which operates a platform called Žlutý melon. We are one of the oldest and leading fintech company in Slovakia. We started our operations in 2012, so also quite time. We are on the market. And we are focusing and operate on peer-to-peer lending, similar than Darius said. We are more oriented to consumer lending. Even there, we have many products. I believe we'll get to that a little bit later during the show. But we also do some other areas connected, which are mainly investment management, but also lending as a service. And that's probably for the beginning.
Okay, thank you very much, guys. Really great to have you in the show once again. Yeah, this podcast will have two major parts. The first one is about market development and everything that has to do with it. And when it comes to the second part, I would like to discuss with you guys a very, very important current issue, which is the implementation of the Consumer Credit Directive, which plays a major role in all EU member states. And we cannot have this podcast without talking about the CCD. Yeah, and let's start with the first part. And let's move on, folks, and look on the market and what's the current state of play with consumer lending in Europe. It's a kind of a warm-up question, so everybody hopefully is able to contribute to this. Who would like to start?
I have to start with this. This is a question where everyone can tell nothing, and this is in a lot of words. Let me say how we see that, or what we experience in the very moment. We experience that we see many companies in the market with funding requirements in the consumer lending area. So we are talking to a lot of companies in the UK, in the Baltics, in Spain. Basically almost everywhere, but this is a good news. The bad news is we're not alone. So a lot of investors are with us, talking to looking for very similar type of returns, which we are looking at. We're looking so what we're promising our investors is roughly 6 to 7% net of all costs, and so that means we are targeting returns of 7 to 9% from the lenders, and this is like a spot which is quite attractive for many banks. So we feel that there's a lot of activity in the market. Many transactions are happening, and a lot of refinancing is going on, and it's a very attractive phase actually. So competition is always good.
Okay, what's your view, Darius and Roman?
Yeah, so maybe I could tell a bit more about Lithuanian market. So in Lithuania, we had this kind of boom in specialized banking licenses. There are many companies who applied for these kind of licenses in Lithuania because a few years ago, it was the easiest way probably in the EU to get the license with the lowest equity requirement and so on. So the market is kind of used to change a bit because there are some new specialized banks trying to compete in this consumer credit market. Where we are in this market, based on like pricing, I would say that we are in the middle between banks and non-banking lenders, because this is probably because we have like a peer-to-peer lending, which allows us to have like a different interest rate for different credit scores and different risk profile clients. So we can issue kind of more personal pricing to clients, so we can compete in this banking space with low interest for borrowers, and also we can price higher and compete in this non-banking alternative lenders. So this is kind of the Lithuanian one.
Okay. Mm-hmm. Roman, what's your take?
Maybe I would also say that I don't have that much overview of the details of the whole European Union, or actually individual countries, because I know level of framework, but also the platform and the market differs. That so I would more focus, as also Darius did in Lithuania. I will more speak about Slovakia. But what I see, there is surely some influence coming from the EU, mainly from the regulation. We know that just not that far ago there was introduced acts on SME crowdfunding, which was quite a big thing also here. Even we are not part of it as we do just the consumer. We are looking also at that market, and we would like to introduce also SMEs loan for the beginning. For the future, but maybe that is not the answer on your question. So what I see mainly in the Slovakia market, there is some upcoming expectation. Let's say maybe from more regulation is probably the right word, but I like to say more standardization, which I like that bringing more rules to the general legal framework of this area. So that's one thing. Second thing is that we had this era of higher interest rates, surely, which probably all lenders and platforms could see, that the investors had much more choice for investing also to other assets. But this is shifting now back to the, I believe, norms and standards. And lastly, what I would also say, and I don't know if it's the trend all around the Europe, but we see it here at least in region that over the last and maybe already the decade, banks did a lot of investments into their infrastructure, user interface, and digitalization, which surely is then more challenging also for the fintech companies as we are, and we are surely trying to be always few steps ahead, but the competition is quite hard also on the market. So this is my overview. How would I see it?
Okay, thank you. This brings me to my next question. Are there any significant trends in addition to what you have just outlined in the market? I think about embedded lending, things like this, Is there anything where you say, hi, this is really a very important development that is currently happening with respect to consumer lending?
It's a difficult question for us, because what we are looking is we as an investor, we are looking, we don't necessarily look at embedded finance as such. We look at different business models which might be financed. The typical model we like is we like X crowd lending platforms or P2P platforms who are developing to more institutional business. This is something we like, and we see that as a trend, that those crowd lending platforms more and more develop into that they reduce the crowd, or that in relative weight reduce the crowd, and that many of them, like Aux Money in Germany, they close up the platform completely and being purely financed by ABS structures or by institutional investors. We see that as a general trend. And we see that we are adapting our model that we offer structures or financing structure for those lenders as well. We hardly touch buy now, pay later financing, even if this is still a major trend. But we are a bit afraid of like, and we will come to that in more detail, I think, when we talk about regulation and about the Consumer Credit Directive. I think we like having a proper credit analysis for each individual loan, and with many buy now, pay later lenders, we just don't have that. So we'd rather go for let's say somehow larger loans, and we rather go for longer data maturities between, let's say, 2 and 7 years is a bit of a sweet spot for us. And so and that basically closes our appetite, or we don't have a lot of appetite out of that for like typical embedded finance operations.
Okay, thank you. You have just mentioned something really very thrilling. This is the fact that an increasing number of fintech lenders is opening the doors towards institutional money. And this is my next question going to you, Darius and Roman. As far as I know, FinB and ZRTY Melon once started with retail investors only, and then you started this development as well. The questions I have now is why and when did you begin to allow institutional investors such as nordIX on your platforms?
When we started as a peer-to-peer lending platform only, we saw that we managed to grow volumes of loan applications much faster than we can attract retail funding. And we kind of started noticing when that retail investors are struggling to fund all our supply. And by putting a little bit of money together, co-financing together with retail investors, we can originate much more loans because you fund a loan to like 80%, like 90%, and it stops and you need to wait a few more days for it to get funded. So you lose client. So if you put like 10%, 20% of your own money or institutional money into it, so you can originate a full loan. So it happened, I don't know how many years ago we started co-investing, maybe like 6-7 years ago. And later on, we saw that this model kind of works. So we started looking for other partners, institutionals like nordIX, who would co-invest together with retail funding. So there is one thing. So basically, institutional investors, they just support retail funding and allows us to grow our loan books faster. There is also another thing in peer-to-peer lending, what we have noticed, that institutional investors allow us to balance funding a little bit, because we see with the volume of applications that it can fluctuate, it can grow faster at times, it could slow down for some reason. But with the retail funding, it is more or less stable. So basically, probably it's because like a group of people, a couple of thousand investors who just invest more or less the same amount each month. So, and if you have fluctuations in the supply of loans, you cannot, you kind of start struggling with retail funding. So that's where institutional money can come in and allow us to balance these fluctuations out.
Yeah, interesting. Thank you.
I would almost sign what Darius said. So I think we have very, very similar experience and history. Naturally, we started as a just really pure peer-to-peer lender, but by that you are limited by certain conditions, market size, but also conditions on the market, and you are trying to make a best product for all category of your clients. So surely we can simplify that investors and lenders even might be a little bit more difficult, but for lenders, you are also trying to be on the market as competitive as you can for the standard or bigger financial institutions. And one of the things which is limitation for the pure peer-to-peer model is the speed of the process itself, how quick you can deliver money to the people who are asking for that, and it's big disadvantage comparing to other institutions, what we also saw. And but naturally there are other factors, exactly what Darius say. You are trying to continuing growing. For that you need more predictable offer of money, so bigger investors. And but on the other hand, it brought, when we started implementing this strategy, what we realized at the very beginning, it brought also a lot of liquidity for our retail investors as well. So there was not only benefits towards the borrowers or the lenders, but also on the investors themselves. And maybe just one point what I would add, that I still see a lot of positive signs or positive effects also on the retail base. It's much more stable in the bad times, let's say, and we surely have to see, and we don't see what is coming in the future, but we know there are national circles on the market, and we are very happy to have more kind of legs and basis, a firm basis on the ground. So we are happy to somehow manage expectations of all types of our customers on the investor side. So still we have a lot of nature retail investors, smaller ones with couple of hundreds, bigger ones with tens, thousands of hundreds, and we are happy that we also can cooperate with bigger investors, as surely, for example, nordIX is.
Okay, fortunately, we have an investor sitting here today as speaker, and let's ask Claus about what exactly is the appeal of this asset class. So they have now opened their doors to make it easier for you entering their platforms. So what do you find so appealing about this asset class, Claus? And what I would also like to drill a little bit deeper into, what's your strategy? What is it exactly you're elaborating to the benefit of your customers?
Let me start with a quick replique to Robert and Darius. Actually, we like being just a part in the financing structure of a consumer lender. Actually, so we like having that you are having retail on board and having alternative financing sources. So we hardly want to be in a position where we are sort of the the one and only and the major leading financing partner. So this makes our life even more complicated. The idea behind what we're doing is having a alternative fixed income product in the market. That was basically the idea. And you might remember March 2020, when the first Corona lockdown was introduced, and stock exchanges and markets were completely dislocating and collapsing. And we are the fixed income asset manager. We do credit, so we usually do investment corporate high yield credit, and all of this market was completely dislocated, and our investors were all massive drawdowns, and that was at the time where we said, okay, we want to have a product which is kind of a completely diversification of what we do currently. So we want to have a diversification in regular capital markets volatility, so we want something which where capital market volatility is not rolled into the product, and we want something which has a diversity effect in the case of in stress cases. So when you have stress in corporate credit environment, there's an administrator coming and liquidating the company. And when you have a similar stress in a retail environment, so when I can't pay back my debt, I might be taken out of my social life for some reason, so I can't rent flats, new cell phone contract, all that gets complicated. And the only way to get my life back is to pay back my debt. So I have a completely different recovery pattern between a corporate credit and a private credit. Yeah, and that was a reason to say, okay, let's build something which has, in that case, a completely different payout and recovery structure, and has a real diversification to our clients in stress in periods of stress. And that was a major driving force for us to look into consumer credit as a potential asset class. And then we realized it's not easy, So investing a larger amount of money into consumer credit is not easy at an attractive level, So you have smallish countries like Slovakia or Lithuania, where you can't easily invest 100 million euros at one point, So it's just impossible, While you have the UK, which with massive lenders, and if you go there as a sort of a startup project, say, okay, I'm happy to invest 5 million at one of the large non-banking lender, they just don't even recognize, So it was really sort of an interesting puzzle to get started, and so I'm very happy that we met Darius and Roman in a very early stage and found partners which basically grew the product which we are having and we could align their growth with our growth, and that makes it very successful.
Okay, thank you. Very interesting. Let's talk numbers, guys. And to add a little bit more color to our discussion, how much can you earn with consumer loans on average?
In our case, our interest rate, which is paid to investors, retail and institutional co-invest, so it's around 14 to 15%. So 14.15. We charge total APR. It's a bit higher. It's around 25, 26. So this is kind of our margin on top. We have default rate of at around 11%. But our collection performance is quite strong. So we collect close to 100 of defaulted principal in 5 years. So this basically brings the credit losses down to around 2.something%. So in the end of the day, you end up with the return still in double digits, maybe like 12, 13%, 11, maybe based on portfolio and the distribution on credit, different credit ratings. But it's still we managed to pay our investors kind of double-digit return.
And Roman?
We have more lending products, and the way why we are trying to have diversified also on the product size is first to find our sort of niche and better offer towards the clients, competing to our competitors, which are now mainly the standard institutions, but also to have much more broader choice and better choice for the investors, and it doesn't matter what type of investors it is. So actually, it's a pure on the investment strategy. If the investors wants to invest more in the maybe more stable, but surely with lower return and more secured investment products or the loan types, or to more those which surely bear more risks, expected default, but also have higher interest rates. So for me, I can and I will say some averages, but what I want to stress or focus on, it really depends on the concrete product type we are having, because we are having standard unsecured loans used for consumer, which are starting from half a year up to 8 years. Maximum loan size is but it's 15,000 euros. But we also have several loans which are connected to the financing of the real estates. They are all consumer, they are all for individuals, but usually where people are buying new or the flats, there can use other products. In generally, duration of our loans is about 3 to 4 years. Pure average of the interest rate is around 9.5%, so a little bit below 10. But again, it really differs on the product and also on the risk category, because probably very similar as Darius has on his platform, there are risk types and risk categories, and really the interest rate is coming at the moment. The current rates are starting about 6.5-7%, and they can go up to 20 to 23% on the platform. But the net is a little bit below the 10. Default rates, the at origination, and surely probably the little bit different consumer customer type than Darius mentioned. We have lower at origination is somewhere around 5 to 6%, and the actual, which also counts the collection, is also below 3%, so 2.5 to 2.6. So next return for investors is a little bit less than 10%, somewhere around 8 to 9%. But again, really depends and differs on the product type and investment strategy what investors choose for himself.
I bet we will have a couple of consumer protection professionals, let's call them like this, as part of our audience. And why they have heard this now, I think, especially when they come from Germany, they will have now some kind of headache. What we perhaps have to call out at this point, and I really want to be very serious here, and perhaps, Claus, you can elaborate on this additionally later on. We have a really very different landscape when it comes to interest rate, right? And the closer we move eastwards, the higher are the interest rates. So it must be absolutely clear for everybody in Europe listening to this podcast that the interest rate landscapes is really different, and this is the reason why we have just heard these numbers. But Claus, since your company nordIX are invested in so many different countries of the EU, so what's your take on this? So what can you tell the audience? What the especially in view of return, what the development is, and what do we have to know to have a better feeling?
You said a lot, Konstantin. You said a lot, and I can underline that a bit. So first of all, I think we always have to. So comparing interest rates with interest rates is always very complicated. So the market is not just separated by region or by country. I think this is one thing, and every country has its own regulations. So Switzerland has an interest rate cap at 12%, and Holland has an interest rate cap at 14%. Germany doesn't really have an interest rate cap, so it's just twice the normal interest rate, so whatever that means. And I think Lithuania doesn't have a proper interest rate cap. I think it's a couple of 100%.
We do, but it's 75.
It's 75%, so it's not really an interest rate cap. Denmark has an APR cap at 30%, so it's different everywhere. This is one thing, and the second thing I think is which type of market within the region you look in. Yeah, so I looking at prime or near prime or subprime clients. Yeah, so and there you have different APR, completely different APR patterns. So for us, we have as a rule of thumb, we don't look at business models which have APRs above 50%. Within that APRs, we might find loans which might go up to 100%, but this is the absolute maximum within single loans. But the business model itself can't be above 50% APR. This is something we want to avoid. Bringing people into a debt circle where they simply can't get out again. The next thing is we as an investment fund, what we want to do is we want to have a diversified portfolio. That means we want to have different regions, we want to have different customers, we want to have different business models. As I mentioned, we're targeting 6 to 7% for investors, but we can't invest all our money with Darius, So simply, it's the country is not big enough. We like Darius, and he's a very good company. The same is true for Roman, but we can't give all our money to them. So we have to have diversification, and that means we have countries like where we invest into Switzerland, where you have completely different return profiles. So you have much lower interest rates, you have much lower default rates, and you have a different regulation apparently. For investors, I think it is extremely complicated to get a proper picture about what's possible in consumer lending across Europe. I think the retail customer is even more educated at least in Germany than the institutional investor. Yeah, because the retail customer they get from this lending, what is this, multi-lending platforms like Mintos or Bondera. They get a lot of offers and they get a lot of potential there, and many of them are fairly good educated. While if you go to the average insurance company in Germany and Austria, they have never touched consumer lending as an asset class. So it's quite funny. And when you go up the next level to the very large insurance companies, to very large investors, there you have very professional type of infrastructure, which has to deploy a massive amount of money. So if you look into the large US banks with large balance sheet, they are happy to invest in consumer lending with hundreds and hundreds of millions of euros, which can't be really deployed within the fragmented network of the German market, of the European market. Sorry, I think it's quite difficult for an investor to find the right country, find the right partners, apart from us, apparently.
Okay, yeah, thank you very much. This was very helpful to better understand where you come from, Claus, with your company and where your limits are. I think this is really a very clear and very straightforward message. Very important to hear this. Yeah, let's perhaps stop here as far as the general perspective and the market development is concerned. And let's switch over to our next big issue of today's podcast, which is the Consumer Credit Directive. As I have initially told the audience already, the implementation of the CCD is really a major issue in all EU member states. And Germany has started only 2 weeks ago with the consultation process. And this is really one of the most important issues in Germany as well. And what impact do you expect this legislative act to have on digital consumer lending in the future? And here I would really be keen to hear the investor's perspective and the platform perspective. So what do you think? What will change, if anything will change at all?
Well, in our case, in Lithuania, we have a regulatory bank of Lithuania who is always kind of the pioneer in regulation. So when peer-to-peer lending appeared in the market, like the first platform in Lithuania was opened in 2014. A year later, FinB started operations as well. So the regulation of peer-to-peer lending came into place, if I remember correctly, in 2016 February. So basically, they were very, very fast regulated. In general, consumer credit market in Lithuania is regulated quite heavily since 2012. So, and now when we see at this CCD, it basically, regarding Lithuanian regulation, it mostly changes nothing, because the rules that are in CCD, they has been already applied in Lithuania in most cases. So from our perspective, it will change actually nothing, I would say. There will be one kind of important change to the market itself, that since CCD, leasing of phones and tablets used to fall under exemption from consumer credits. there was something in the regulation that if you don't charge interest and these kind of devices are necessary for providing your services, so you can lease them kind of free of charge to the client, and this is not a consumer credit. So when CCD comes into force, this will fall under the consumer credit as well. So all this market of smartphone leasings, which is kind of big thing, I think it should amount to maybe 10 to maybe even 20% of total market in Lithuania. So all these leasings, they will become consumer credit as well. So this is, I think, the only major change. So what it's going to do, so the market itself will grow. For some clients, this might limit their access to funding, because now we have also in Lithuania, we have this DTI, debt to income ratio cap, that you cannot, person's monthly payments for all of his liabilities cannot amount to more than 40% of his stable income. So till now, all payments for smartphones, they were not included in these calculations, and now they will be included. So this might, for some people who are they are kind of indebted on this cap, DTA cap, they will not be able to get new loans because their kind of indebtedness will increase, which actually it won't, because it used to be this way, but just from a regulatory perspective, it will. So this change might kind of change the market a bit. But other than that, I don't see any significant changes in the Lithuanian market.
Mm-hmm. Yeah, interesting to hear that you guys in Lithuania already have such a high level of consumer protection as regards the consumers. Okay, interesting. And Roman, what's up in your country? What's your perspective?
Yes, so in Slovakia, I surely don't know that much details of the other market. So for me, it was interesting now to hear Darius about his experience, and I would say there are some very big similarities but also a few differences. So one of the big similarity is that our regulator already started the initiative of increasing protection of the financial customer already some years ago, and the protection nature standard of the financial customer is very high. So from this perspective, surely we are now still waiting for the big, because this CCD Directive 3 has to be implemented in the local legislation. So we are now surely seeing some proposals. They're now in quite early stage. So we are following the process itself. But I would say if I would skip the details, I also don't see that much increase of the general protection of the consumer, which now wouldn't be covered for already existing legislation. So that is probably very similar what also Darius said is experience in Lithuania. One difference with us is that we are not regulated by the same regulation than banks or standards financial institutions are, and we don't have this legislation in place for the peer-to-peer lenders. On the other hand, and that was probably could be read from the numbers of the returns and the risk, and the target audience we are trying to find is bank prime or bank subprime. So we are not really going to the fields where the standard institutions aren't offering their products, and therefore, even we are not regulated by the same regulation framework, most of the already existing regulation we fulfill, and we have implemented the rules and standards. We are very strict on the risk side and data which we are verifying on the application and on the borrower side, because just purely we want to focus on those prime market. And so coming back at the beginning, we are closely monitoring the local implementation, because this is for us the most important. So far, we haven't identified any bigger issue which would force us to change dramatically some product parameters or the verification and the risk processes on our side, or collection even. So there might be some small, or there surely will be some small updates in the general legal documentation for loans. But so far, I don't see anything which would dramatically would force us to change the model.
Okay, thank you very much. And Klaus, what do you expect from the CCD implementation? And I think due to the fact that you're invested in so many different EU member states, so you have really a very broad view, don't you?
Thanks for the compliment. I'm not sure. I'm not sure. So first of all, I think the CCD will really hit those operations which don't do a proper scoring, so and loans below 200 euros will definitely be changed, have to change the business model. We hardly finance those models, so we will not really. So our partners like Darius or Roman, they're not really hit by the CCD, and this is true for 95% or 98% of the loans we are having in our portfolio. Nevertheless, we like regulation as an investor. So the more regulation we are having, the better it is for us as an investor. We like the regulation in Lithuania, where you have a maximum debt to income ratio. So this is something which I really appreciated. I would really appreciate if we have that across Europe. So this would be something extremely helpful to us. And we see major differences, mainly in with regard to recovery values, which are correlating to regulation. So the higher the degree of regulation is, for instance, debt to income ratios, the higher the recovery values are. So and we see that across Europe. And if you compare, for instance, I think the worst recoveries we're having is in Spain, and the best we're having is in Lithuania. And this is clearly a function of regulation. And the more we can harmonize regulation, the better it will be for us as an investor, and the better it will be for growth. I think one of the reasons why Lithuania has this. I think this is outstanding. The growth of the non-banking lending or platform lending in Lithuania, if you compare that in ratio to let's say the amount of people living in the country to other countries, you have a fantastic growth there, and this is clearly because very early regulation, very clear, and I think if CCD brings us more into that will be clearly very good changes. And one thing which might also be added is you see that more and more countries have introduced regulations. So if you, Darius, you mentioned you're going to Poland. So if you look at Poland, what they did 2 years ago, there's interest rate cap introduced, and suddenly the market is changing. So and more players coming into the market offering proper product which are really helpful to the people, and so clearly regulation is helping here.
Yeah, okay. We will get back to possible future regulation in a couple of minutes. It's a very important point that you have just mentioned, and plays a major role for our industry. But let's wait. Before that, I have another question. And this, which exerts influence on our discussion. Two important aspects of the CCD revision are higher demands on credit risk management and greater protection for borrowers against over-indebtedness. What's your strategy at ZLTY Mellon and FinB against excessive debt today and tomorrow? We have already discussed that buy now, pay later and all this stuff does not really play a role for our discussion here and for our industry. That's something different, and we don't need to lose any words on this. But due to the fact that these two major aspects are so much highlighted in the CCD package, it's really important to hear from you. What's your take on this? So how do you approach this?
So, as I mentioned, in Lithuania, we kind of already have this DTI cap. We have a requirement to validate borrower's income to calculate only sustainable income. That means that you need to exclude any like one-off payments or even bonuses and stuff like that. So regarding that, Lithuanian regulation isn't going to change because this kind of protection over indebtedness, it's already quite high in Lithuania. And that means that we need to check everything. Basically, we need to double check a client's income in databases based on account statements. We need to check his liabilities in databases, credit bureaus. We need to check his registration address, his like residential status, and and many things like that. So it's, I mean, I can't imagine how can you get even kind of harder and more tougher on this regarding the regulation. So nothing is going to change in Lithuania.
Okay, thank you.
In Slovakia, or actually Slovakia, but also specifically our approach is very similar. From the very beginning, we knew that if we want to succeed with this project, as I said at the beginning, we started in 2012, so we already established quite good and long established portfolio. We have to be very strict on risk management, because at the end of the day, all this game is about the proper risk management. So you have to fulfill the expectations of your clients, either are the bigger investors or the smaller retail investors. They have to know what returns to expect in general, what default to expect, and what I get out of it. One of the, except of maybe democratization, the predictability of the returns, despite of a lot of external circumstances, is one of the factor which for me was very appealing in this asset class. I think you asked these questions to Claus at the very beginning, but that would be my answer. And but coming back to this concrete question, so we already have in place a lot of factors we are checking and on every application, every borrower. So bank transaction statements, 3 to 6 months is one of the key we are really checking, and on the sustainable income, on the concrete costs. We are expecting other loans which clients are paying. We have established, or we have set fixed and strict criteria on debt to burden ratio. We also have implemented a lot of kind of chaos or gray zone criteria or red flags. For example, we are very strict on betting and gambling. I don't know what is the experience in other countries. So, for example, but in Slovakia, this sports betting and gambling is actually driving the market, and we see it as one of the very big risk factors. So people who are betting big part of their monthly income just cannot get a loan from us. And surely there are a lot of external debates with the potential highlighting the problem of them as an entrepreneur, then as an individual, then with repaying other loans. So all are those signals which those people just cannot be approved by us, and therefore cannot be put on the market for the investors to invest. So responsible lending, if I can say it in one word or one name, is something we were driving from the very beginning, just to fulfill our strategy from the very beginning. So also that's why I don't expect that, and I don't see that any big updates of the local legislation due to CCD3 would hardly impact us.
Okay. Yeah, thank you very much, guys. And now I would like to get back to what you, Claus, mentioned before with respect to additional regulation. This plays an important role within CCD for our industry. As I've mentioned before, currently the European Commission is exploring the option to integrate the consumer credit into the European crowdfunding service provider regulation, according to Article 46, Section 2 of the CCD. And from my point of view, this is a marvelous chance to hinge the digital consumer loan on the wide capital market and regulate it uniformly across the EU. And we have heard now that as far as the investor perspective is concerned, Claus would like it. And as far as I have understood what you, Darius and Roman, you have mentioned before, you would like it as well, because it would make your job even easier. So what's your take on Article 46, Section 2?
I think it would be a really positive change because, again, as I mentioned in Lithuania, we are pioneers in regulation. So even before the crowdfunding regulation, European one, we already had a crowdfunding law, which came into force even before FinB was the first crowdfunding platform in Lithuania. And so we were waiting for the license to start the business because it was not allowed before the regulation came into force. So again, when the European this regulation came into force, it didn't change much in Lithuania. But what it did change So that now and before, we kind of at Finbi we have two products, right? We have consumer loans and SME loans, and consumer loans are regulated by consumer credit law, and SME lending is regulated by a crowdfunding. It used to be a crowdfunding law, now it's a crowdfunding regulation, European. So, and there are some different aspects, especially related to investors' protections, how it's being done. So, from investors' perspective, I'm pretty sure that if you take an average investor, they cannot tell the difference. The difference between consumer lending, peer-to-peer consumer lending, and like crowdfunding for SMEs, right? It's from their perspective, it's the same, but from regulatory perspective, it's not. There are different rules. So if you want to invest at Finbi in SME loan, you need to go through some questionnaire. If you want to invest in consumer loan, you don't need to do that, but you have some limits which allows you to invest up to, like, let's say 500 euros per one loan. So it's the same thing regulated differently. So that's one take why I think it should be good to have like the same rules for both these products. Other thing is passporting, because now crowdfunding European regulation allows passporting within the EU, and peer-to-peer lending for consumers, it's regulated on national level, somewhere unregulated, somewhere regulated, which kind of restricts quite a bit international expansion. So I think that's maybe one of the things why we don't see pan-European peer-to-peer lending platforms, crowdfunding for platforms. We don't see maybe as yet too, but I hope they will come. So this passporting thing, I think it would help European market to work as a uniform market, not a fragmented one.
Mm-hmm. So in Slovakia, as I mentioned earlier, we don't have special legislation for consumer P2P lenders. SME crowdfunding license requirements were introduced due to EU legislation 1.5 or 2 years ago. And as I also said, at Zloty Melon, we are at the moment providing only consumer lending. But I also said that SME lending is something on our not only list, but something we are hardly working on, and we already initiating the process with the local regulator for getting the license for SME lending. As we were exchanging emails and chatting before the show, I read your position as a digital lending association towards this point, and again, I fully take your points and what you are highlighting there, that platforms and surely now focus on the consumer side. What we have to protect is not only consumers on the side of lenders or borrowers, but also consumers on the side of investors. And this is not that much covered by the CCD, but on the other hand, it's quite good covered on the current regulation for SME crowdfunding. So from this perspective, I would fully support, and I support that the regulation should really take in consideration the differences between platform or marketplace lending as such, and not put it in the one basket with the standard financial institutions loan provision, because just the model is different, and if you try to protect your customers and consumers, you have to really see their position from all perspectives, not only those who are getting money. On the other hand, and that is something, and I'm not lawyer, I'm not that much deep in the legislation process. Only one thing which I'm not sure is how feasible would it be that the consumer crowdfunding, let's generalize it like that, could be protected by or could be regulated by the same regulation as SME crowdfunding. Because in SME crowdfunding, actually, the borrower or debtor is professional, so is a business. It's not individual. It's not consumer. So there are a lot of aspects which are focused on protecting investors on the platform, and that is very good. And as we are now really in the process of starting the license, I'm really in the detail of that, and I would fully support the taking majority, if not all of that, and putting also on the regulation for the consumers. But surely you somehow have to implement also that the borrower for the consumer is also the financial consumer. But for us, definitely taking this out of CCD and putting in the special regulation would make much more sense than the current status of the proposal is.
Thank you very much, Roman. And for you as well, Klaus, right? And I remember, Klaus, that we have been discussing this issue already at an earlier point of time. And one thing that we have been discussing was, would it perhaps even the better idea to leave the ECSPR where it is and to simply take the whole consumer loan into scope of AIFMD? And your argument earlier was, yes, this is a regulation where the institutional investor has already been neatly been reflected.
So first of all, we like regulation. The thing with consumer loans, and please, Roman, Darius, correct me if I'm wrong, is that countries tend to have or governments tend to have a special look at their consumers, because these are the people who are electing the governments. Yeah, so they have they feel they have to protect the people with extra care, and you so you have a lot of overlapping regulations everywhere, and this makes so I think that there's a lot of harmonization which would be much more needed at the very moment. So to give you an example, we can't invest into Italy because in Italy it is just not allowed by law to transfer consumer loans to a foreign country. Yeah, so that makes it nearly impossible for us to invest in Italy. And you have this type of special situations. In Germany, in Germany, loans can only be granted by a bank. Yeah, so that means every platform has to have a fronting bank, and Sweden is going in the same direction at the moment. So Sweden is going 2 steps back, which means either those lending platforms in Sweden, they have to transform themselves into banks, or they have to introduce a model of fronting bank. And I think the harmonization of this type of overlapping regulation would be something which would extremely helpful for us as an investor, and would probably attract more investors into that segment, because finding a solution for each and every country where you have a fronting bank, where you have a local SPV, is just painful and expensive. So our interest is really getting this harmonized, while we don't necessarily look at crowd lending legislation at the very moment.
Mm-hmm. Yeah. Okay. So at this point, I think we all agree that it would be a fairly good idea if the European Commission were able to nail this down and would open the ECSPR for consumer credits. Yes. Okay. Thank you very much. We have already reached the end of our podcast, and now that's it's time for our traditional for the traditional part. That's a crystal ball question. In consumer lending, we have intense competition between bank lenders and non-bank lenders today. We have heard about it at the very beginning of the podcast about it, and the total market for consumer loans is around 700 billion, and between 30 up to 40% of this amount gets refinanced every year. What share do you think non-bank digital consumer lenders will be able to capture across Europe in the future? A real crystal ball question.
Well, I can say that at least in Lithuania, currently, consumer credit providers, non-banks, has close to 30% of the market. So it's I'm not sure what's the European Union number is, but I think that
30% is really impressive. 30% is really an impressive number, I would say.
yeah. So I think we can expect that anyway, market share of digital lenders, I think, should grow. And well, I don't know, me myself, I believe that you need to focus on something and to kind of get to be great at it. So from a bank's perspective, I still see that at least in Lithuania, well, they are using like standard products for standard people. So if you have, let's say, income which is not standard, if you are like, I don't know, sole entrepreneur, or if you rent an apartment and get a salary, so these guys at the bank, they usually, it's hard for them to understand different income than they are getting themselves. So usually if you work at a bank, you get a salary, right? And that's it. So, and if you are like a businessman or do something else, so you have more types of income. So, and when you go to the bank, if you are like a standard person, you can get a loan, well, pretty easily. But if you have something non-standard in your life, so it gets things gets complicated, and you need to go to get elsewhere. So I think this kind of, I don't know, maybe flexibility or personal touch of the clients, and getting just focused on let's say consumer lending only, and not on like 5 or 10 products at a standard bank. So I think this is kind of creates you an edge, competitive edge against the traditional lenders.
Okay, thank you. Klaus?
We will always have a much cheaper funding than any non-bank lender can have. So the vast majority of at least the prime and the near prime business will be in banks. But everything below that is attractive for non-bank lending, and is attractive for investors like us. And so I think the vast majority will be within the banks, and I think these 30% of non-bank lending market share in Lithuania is a fantastic number, and I'm a bit surprised that it's that high. Germany is much lower, and the rest of Europe, I think, is also much lower. I think we are talking like more like 8 to 10%, which we are seeing there. But I think this can be grow, but there's a natural limit to it. I really feel because the banks have so much cheap funding.
Mm-hmm. Okay, so thank you very much. We have come to the end of today's show. Thank you so much for your time, Klaus, Roman, and Darius. It was a huge pleasure to have you in the show.
All right.
Thank you for having us.
Thank you very much.
Thank you.
Thank you everyone for listening. You have hopefully enjoyed this episode as well. Please make sure you subscribe to our podcast and save the date already today. The third Digital Lending Summit is going to take place in Frankfurt on 1st of October. More information in our show notes. Stay safe and sound, and see you soon.
Thank you. Bye-bye.
Thank you.
Thank you. Bye-bye.